Well, for more on what these jobless claims numbers mean for the markets and for some reaction, let's get to Bill King. He is author of the Daily King Report and market strategist at the Chicago trading firm M. Ramsey King Securities in Chicago. And thanks so much for joining us, Bill.
You're welcome.
The fact that we've gotten this rise may be a little bit of a surprise to the markets. Who knows? But you say we shouldn't be reading too much into these claims.
Well, yes, most of the economic data, you've got to look at the details. Last week we had this enormous 642,000 drop in the continuing claims, but it's largely the product of seasonal adjustments, which has been wreaking havoc with all the economic data. And of course, it's because of the way they're accounting for auto workers, it's been creating a real problem over the last several reports. You also have the exhaustion rate, people exhausting benefits. The economic problem we've had has been so extensive, it has been so prolonged that people are losing, they're dropping off of the state rolls, going on to the EUC, or the expanded unemployment compensation. So, this is something we had talked about over a month ago, that somewhere you're going to see huge drops in continuing claims because people are just exhausting their benefits. I think as of the end of May, it was 49.17% of Americans had already exhausted their jobless benefits.
Then would it follow, Bill, that these numbers, these weekly claims numbers, which we've been following so closely over the last several months, are going to matter less and less?
It could, until you can see some real change in the employment situation and not just people losing benefits. If you can see where there is organic job growth and people are hiring, rehiring again, then you can see some meaning, be more meaningful. But right now, what you have to be able to differentiate seasonal adjustments, and the second is exhaustion rate. And we'll get a better idea of this in a couple of weeks with the July employment report comes out.
Well, what are you expecting for that? I mean, given these numbers, given the rise of 30,000 claims, I mean, what do you expect for July then?
Well, the July, I think the report could be surprisingly ugly. I think right now the early projection is for a decline of about 440,000 non-farm payroll. But one of the things that happens in July is one of the 2 months where the BLS has deleted jobs out of their business birth-death model, which is the model that is supposed to account for small business formation and jobs that they can't count, but they guess is occurring. Mm-hmm. There's a huge deletion in January, over 300,000 because of Christmas. Up until about 2007, you lost between 50 and 70,000 jobs in July. Unfathomably, with the economy weakening in 07, 08, they started increasing jobs in July. So last year you had about 24,000 jobs generated by this business birth-death model. Now the problem becomes the 3 previous months to July this year, that birth-death model has generated about 221,000 jobs. Yeah. So going in to when the BLS is going to compile the establishment survey, they're going to have about 200,000 less jobs into the raw data before it becomes seasonally adjusted.
Right. Yeah, you got to take that into account then, something that's
exactly.
Not obvious, right, in the numbers that are published.
Exactly.
Bill, we only have a few seconds, but tell me you've been a trader for over 30 years, so tell me, what are the markets pricing in, though, right now?
I wouldn't read, you're getting a boost for the earnings a bit here, but the market's really trading off of the easy credit. The stocks were down before last week. We're trending lower for about 4 weeks. We had actually been sideways for about a month and a half. But last week, Ben Bernanke hit the accelerator again. Fed's balance sheet blew up by 80 billion. So, the people in the market, the traders, especially mortgage-backed traders, saw Ben back in the market last week. It was after an expiration week. They hit the accelerator. We get an explosion. So you can see this in the dollar. There's like a negative 0.98 correlation with the dollar and stocks. Yeah. So a lot of this is the Fed becoming easy again. And, of course, part of that evidence is China started squawking again 2 days ago about, we're going to dump our reserves and buy some assets. That's kind of the game here. China warning Bernanke, don't go too easy on the credit. And so that's what you have to watching forward here is the dollar and the Fed credit.
Okay, we'll be watching those then, Bill. Thanks so much, and great to have you on our program, Bill King of the King Report.